let's address more earnings. Arijit Basu, who's MD and CEO of SBI Life, joins in to discuss their earnings outlook. Mr. Basu, it's good to have you on the show. This is your first call post listing. Let's start off with how the overall quarter has been. And insurance is a segment where we want to essentially understand how the premium growth has panned out and how sustainable it is, given the fact that we are an underinsured country.
Thank you very much. Good morning, and we are very happy to report our Q2 and half-year results. We've done very well across all parameters, whether it is in revenue growth, whether it is in profitability, or whether it is in other qualitative parameters. In revenue growth, we've had in individual new business premium a growth of 45% in this quarter, and we are maintaining the trend that we have shown in the last 2 years. In the half year, we have grown in individual new business by 48%. And if you look at our total new business on an annualized premium equivalent basis, that is taking single premium as 10%, 10% of single premium, then we have grown at 37%. So it's been a very, very strong showing in line with what we have delivered when we had done in the last 2 years and when we had approached for the IPO. In terms of profitability, our accounting or revenue profits have grown by 6% in the quarter, but for the half year we have grown at 26%. So in the first half of the year, the accounting profits have grown by 26%, and the embedded value, which is the long-term profitability in one sense, that on an annualized basis has grown by 19.5% from 16,538 crores as at the end of 31st March to 18,082 crores as at the end of 30th September. So, right. 18,082 again is the highest embedded value for any private life insurer. Yes.
Right. Mr. Basu, while it's great that your numbers are looking very strong, you continue to deliver on growth, the focus clearly seems to be on your individual business. If you could just highlight what your ULIP mix has been like in the quarter gone by.
Yes, please. So, ULIP actually we had within, we measure ULIP in two ways, overall and individual. Overall, including group products, our ULIP mix was 56%. But if you look only at the individual segment, then our ULIP mix actually came down from 78% in the last financial year to 71% in the first half. So, we thought at the end of last year that we would like to do a marginal correction in ULIPs, which while being very good in terms of reaching out to the high net worth and affluent clients, we need to stretch ourselves a little more to the other client segments as well, and we have managed to do that. So, in the first half of the year, the number of policies sold has also gone up, and the traditional participating mix has also gone up from 10% to 19%. We would like to keep it at this. The other good news is that the protection element in our mix has also increased from 4.8% to 5.6%.
Mr. Basu, cost ratios have trended down. I believe commissions have grown about 51% year on year, driven by 45% year on year growth in individual new businesses written, but pretty much considered under operating expenses. Could you rationalize whether this is sustainable? Because I would reckon that this is linked with your overall embedded value looking higher. So, will cost ratios continue to trend down?
Just to explain, when we calculate the embedded value, we do not take any projected benefit in cost, number one. Number two, our operating expense and total cost ratio has been significantly lower than any of the other players, and which was one of the things which investors had liked when we had gone for the IPO. So, the good news is that the operating expenses has in fact come down during the half year from 9.4% to 8.6%, and there is a marginal rise in the total cost ratio from 12.9 to 13.3, driven, as you said rightly, by the rise in commission. So, commissions have gone up because of the growth in business, but the commissions have also marginally increased because ULIP commissions tend to be a little lower than traditional commissions. So, we have been selling a little more traditional product, but we are very, very comfortable, and we see this trend as being in very much in the right direction, and with operating expenses trending down and persistency also being consistent and improving. So, our 13th and 37th month persistency has improved by 0.20 basis points, 20 basis points, and taking all this together, the outlook for growth in embedded value is very strong, and which has already been reflected in the numbers that we have given, and we see a 19.5% growth in embedded value, which is very, very significant, because in the previous year we had grown our embedded value from 14,000 crores to 16,538, and I think we are on course to repeat a similar performance this year as well.
How much of your current business is coming from agency business, and how much is coming via your branch network?
Yes, so our bank assurance business in the first half of the year grew by 52%, which is very good and in line with what we were doing in the previous years. But our agency channel has also grown by 25%. Again, our agency channel, as you would be aware, is the most productive agency channel with significantly higher traction, and it is the largest agency channel among all the private players, and this has also grown by 25%. The mix has changed to 69% is now bank assurance, 29% is agency, and 2% are the other channels, our online channel and the other distributors, smaller distributors that we have. This is in the individual space. In group, of course, we do sell group term insurance products, and they have also been taking off quite well.
The challenge with the ULIP dominated portfolio is that right now markets are great, and no one is complaining because returns are more than double digit in most of the equity schemes. But when market conditions will reverse, there is a huge risk of outflows, and that could have an impact on your aggregate income as well. So what has been your experience?
So our experience, number one, is that the surrender ratio of SBI Life, again, as I said, in all qualitative parameters we have been maintaining our strength, has been significantly better than any of the peers. Just to give you a sense, in surrender ratios is surrenders to the total AUM, it is down to 7.8% as at the end of September from 10.9% in the previous year. This is just one indication that people who are invested in our various schemes are holding on to the products till the time that they are expected to mature. Now, coming back to your original question on the markets impacting ULIPs, yes, that is a fact, but the clients that we have tend to favor, they have a choice between opting for equity products or opting for debt products, and typically a ULIP driven market would have more equity coming in. In our case, it is just the reverse, and that has been continued in the first half. So, as against roughly a total ULIP portfolio of 50,000 crores, 30,000 crores is in debt and 20,000 crores, roughly 20,000 crores is in equity. So, it is a 60-40 ratio in favor of debt. So, our clients in fact seem to have opted for hedging their risks. So, in case of any downturn in the market or a similar kind of thing happening, SBI Life customers would not be that affected, and therefore we are better protected. Having said that, I think the present round of ULIPs are a very, very well designed product in line with what the regulator has given. The commission rates are low. The amount of yield that the company can take away from the policy holder is restricted to 2.5%. There is a minimum lock-in period of 5 years. Right. And all these, together make the product a very attractive product.
Absolutely. Mr. Basu, just running short on time, so would like to gather some color on what your persistency trends have been like, because there's been a marginal improvement over there. What kind of trend can we see in the future quarters ahead?
Yes. So, we have been able to improve our persistency significantly in the last 1 or 2 years. That trend continues. In 13th month persistency, we have improved from 81.13% to 81.33%. That is a 20 basis points improvement. And in case of 37th month persistency, we have been able to improve by about 50 basis points from 67.2 to 67.79. So, this is a very welcome trend. You would notice that in the 61st year there is a decline, but that is only because of the single premium component, which was very high in that. But in the regular premium component, even in the 61st month, we have around a 1% improvement. And this is what we had targeted. We already are among the top few players, 2 or 3 players who have the best persistency in the market, and our aim is to significantly to continue to improve it. And this is also helping our profitability, as we have grown our renewal premium by 35% as against 26% last year. So, 35% growth is a very, very significant growth in terms of renewal premium, and coupled with a 45% kind of growth in new business premium, our overall revenues look very, very healthy, and the profit also is on the right track.
Mr. Basu, we wish you the very best for the future. About 1% down on SBI Life this morning, but insurance is a space, purely by nature of the demand that's required and the fact that India is an underinsured country, we are going to be seeing a lot of interest coming into the sector. So, we wish you the very best for the future.